Hello, everyone, and welcome to this webinar hosted by VetCPA, sponsor of the CVMA Business Management Program, titled Tax Planning Opportunities for Locums and Practice Owners. We're thrilled to have you join us for the next hour. To help ensure the best experience, please keep your video and audio muted. This will also help maintain a strong bandwidth throughout this session. Our speaker today is Greg Toner, owner of VetCPA and self-professed tax nerd, proudly so. Greg has dedicated his career to helping veterinarians across Canada navigate the complexities of accounting and tax planning. As the leader of a firm that exclusively serves the veterinary community, he works with locums, practice owners, and industry professionals at every stage of their careers. Whether it's optimizing tax strategies, streamlining bookkeeping, or planning for the future, Greg's expertise makes him a trusted advisor in the field. Please join me in welcoming Greg Toner.
Thank you very much. We'll get right into it. I'm Greg, and we'll start the presentation here in a minute. Just let me get the screen sharing all sorted out. There we go. We should have that screen. If someone can give me a nod saying that you can see that screen, that would be great. Perfect. And so we'll do a couple questions at the front end here to just get an idea. But as mentioned, VetCPA is a full service accounting firm, and we deliver specialized finance support for veterinarian practices and locums, cloud-based bookkeeping, accounting, tax planning, practice management support. We do a lot within our group, and we're happy to help you out as much as we can. So our goal here is to help veterinarians realize their goals, and generally we're able to help most in the financial aspect, but we get into other areas as well. So to start things off, we've got a poll that I'll start in a moment here, and we're trying to figure out who is who's in what bucket, and if you can kick that poll off, we'll get some information on the attendees so that I can tailor the presentation a bit. And all right. So looking to get an idea of, if any of you are incorporated, is anyone considering a practice but hasn't started yet? Is anyone a practice owner already? Is anyone working as a locum? And for the people with corporations, do you have a second corporation? And, people at the back end of their career, are you within 10 years of retirement? Just so that I can tailor a bit of what we're talking about here. Not very many second corporations. A lot of people fairly early in their career. Thank you for those who have answered already. It looks like we've got about half answered in so far. And yeah, we'll call that statistically significant here. So looks like about half of the attendees are incorporated. About half are practice owners, little better than half, or about half are locums. So a pretty good mix. We'll balance the presentation today so that we've got everything. I've got my email on the last slide. If anything comes up that you're looking for more information on, please don't hesitate to reach out, and we can set up a time to talk over what specific questions you have. So we'll talk about two big buckets. We'll talk about the easy stuff and the fun stuff. And like a lot of good hygiene, the easy stuff isn't always easy. The two things that I see most practice owners and locums screw up the most is expense tracking and write-offs. So they go hand in hand, and making sure that you have captured all of your expenses is critical in minimizing your taxes. And we'll work through an example to understand exactly how important that is. And then we'll talk about what kind of write-offs make sense, what write-offs don't make sense. And then we'll get into the part that I think is the fun stuff, tax structuring. So making sure that the structure that you have set up is optimized for your situation. And people will say, well, what's the perfect structure? What's the right number? What's these things? Everyone is different. Every practice is different. And I think it's important for us to not lose track of that and not provide cookie cutter answers for people. If you have questions throughout, please feel free to drop those in the chat, and I will keep an eye on the chat. And if there's something that merits talking about right there, I'll answer that question in real time. If it makes sense to wait till later on, we'll work through the questions then. So number one, expense tracking. The most important thing, I think, for any business, regardless whether you're a vet practice, a locum, a physician, a dentist, a mechanic shop, is the appropriate use of bank and credit card accounts. The hardest thing in accounting is assessing completeness. So, do we have all the transactions captured? Do we have every expense? Do we have every revenue line? If you have one bank account and one credit card that are used exclusively for business purposes, this gets really easy because we know if we've captured all the transactions on those credit card and bank account statements, we know that we've captured all the expenses for the business and that we've captured all the revenue for the business. So it means that your record keeping is a lot easier. You can see the current state of your financials more quickly, so you know how things are going. You can make sure that you're capturing all those business expenses, which means that you're not missing out on tax deductions. People say, well, what about this expense? It's kind of on the line. Assume it's a business expense, assume that it works, and then at year end, what we do for our clients is we'll carve it out. We'll say like $70,000 is a lot for meals and entertainment for a locum. So maybe let's trim this down to something a little more reasonable, like $3,000. So if you put it in that on that credit card or in that bank account, then we've got the ability to have a conversation around it. But if you leave it out entirely, there's no opportunity there. So when it comes to bookkeeping, it's really important to use a cloud tool. There are a lot of legacy desktop systems out there. There are systems that do a little bit of bookkeeping and a little bit of practice management. Typically, those don't do a good job of the bookkeeping side. So you want to use a cloud tool because, like, if my laptop blows up today, within 2 hours, I'm back up and running with a new laptop. With everything being cloud-based, it's way easier to deal with any critical issues. And when it comes to bookkeeping, like, you could do it yourself. You're all smart people. You made it through vet college. So I'm fairly certain that you could do the bookkeeping, but there are people out there who do it every day. And then also get them to look after your PST, your GST, your HST. Sales tax is really where things get messy. Bookkeeping is the easy part. Taxes are easy. But there's so many nuances in PST, GST, and HST that I think a lot of people lose track of and don't necessarily appreciate. So now we talked about how we track expenses and how important it is to do your bookkeeping, and a cloud tool is important. The other half of that is deductions. So understanding, can I write this off? People talk about write-offs. They talk about like, oh, it's deductible. It's like, well, okay, but what does that actually mean? So the example I have is $100 dinner. That's maybe questionable. So maybe you're going out with a classmate to dinner. It's going to work out to $100. You're having dinner in Ontario, so there's HST at 13%. So is it worth it? We've got a $100 dinner plus HST of $13. So if you pay for this in the company, you're going to get most, if not all of that HST back. You're going to be able to write off that corporate tax, write that expense off for corporate tax purposes. So you're going to get about $12.20 back. You're going to save $75.30 in personal taxes, because for you to take that money out and pay for that expense personally, you're going to have to take out $188. So you're not going to have to take that money out to pay the personal tax. So if you're paying for that expense personally, you're going to need to take an extra $188.30 out if you're paying it personally. If you're paying it corporately, it's really only going to cost you about $87.80. So that's like $100 difference on a $100 expense. So this is why it's really important. And, this could be a meal, it could be anything, but any $100 expense, this gives you insight as to why it's so important to make sure that you're catching everything, because, you're having the cost in some cases to when you take these expenses and charge them against your professional income or your business income. Any questions up to this point? Seems like the chat is pretty barren, so I'll keep going. If any questions come up, please feel free to enter them in the chat window as we go. So now, yes, you take $100, you can save $12 in tax, get the HST back, not have to pay any personal tax on that. You want to take intelligent risks. You don't want to claim things that aren't real business expenses. You want to only claim true business expenses. So not everything can be a write-off. Your new dishwasher is not a business expense. The microwave for your home is not a business expense. The couch in your living room is not a business expense. And you need to limit the number of gray area transactions, because tax is very little black and white. There's just a lot of gray in the middle, and not everything can be a write-off. As you get in more and more gray area transactions, those become more and more audit flags, and it just increases your risk that someone's going to look at your financial statements and your taxes. The bigger point and what I want everyone to take away is that you want to make sure that you're capturing all legitimate expenses. Everything that is in that white category, make sure you're catching those expenses, because the ones that you're forgetting or you're missing because you're putting on the wrong credit card, those expenses are truly costing you more than you really think. And then use that company credit card well. So when you're at the checkout, make the decision then and make sure that it's tracked then. So that if it's captured on that company credit card, then it's captured in your company bookkeeping and you won't miss it because you lose the receipt. So using your credit card appropriately is very important. So I had one question around the, if you're having a dinner, is the name of the person good enough for the claim? Generally, you want to have the name of the person and what you talked about, or, what was the business reason. And what I do is I just scribble it on the back of the receipt. Home office and things like internet and phone, every situation's different. If you're running a practice and you have an office at the practice, that is really hard. It's harder to justify. If you're a locum working out of your home and that's really your main office, then it's much more legitimate, or a much more legitimate expense and easier to defend. That being said, there's a lot of gray area in tax, and it makes sense to talk to your accountant and make sure that that home office claim is appropriate for your situation. Um, Dinner meetings with shareholders who happen to be family members. I also have a shareholder family member. Um, there needs to be a business nature there. I can't write off every meal that I have with my wife, but there are some legitimate meals that make sense. For locums, scrubs and shoes, whether they're legitimate expenses, they need to be required for the job and safety. So my position is generally that scrubs are a legitimate expense, and shoes, I try and argue for clients to get something a little bit specialized. And then, yes, those are a legitimate expense. And then a separate credit card for business. That's a very good point. Thanks, Randy. So Randy asked, do you need a separate credit card only if you're incorporated? I think that even if you're an unincorporated locum or unincorporated business, it still makes sense to have a separate credit card because it gives you the ability to parse out all of your business expenses. So regardless whether you're incorporated or not, that separate credit card gives you the ability to track all of those expenses in a clean way. Um, a numbered Ontario corporation is not sufficient for a locum in Ontario. The college requires specific naming conventions if you're going to practice as a locum through a corporation in Ontario. And then one question around personal vehicle commuting to and from work, repairs and routine maintenance. So commuting is not a business expense. So the distance between your home and the practice is not a business expense. If you're a large animal vet or you're doing mobile vet work, the travel from the practice to either the farm or the client's home, that is a business expense, but the travel between your home and the office is not a business expense, Vin. All right. I'm going to take a break there and we'll jump in. Okay. Sorry, one more question. Does it change between provinces? So a locum working in New Brunswick and Ontario, each province has different requirements for a corporation, and it's very rare that a corporation will meet the needs of different provinces. So this is something to talk through with your accountant and your lawyer. It may make sense to practice through a corporation in one province and as the sole proprietor in another province. And then for locums, at least well, all locums practicing need to register, all locums practicing through a corporation need to register with their provincial college, similar to how a clinic would register. Okay, rapid fire questions. Thanks, everyone. So this is my sassy picture about, you don't want to have too many skeletons in your closet because you need to be able to close the door. So you need to capture all legitimate expenses, but you don't want to create a headache for yourself in the future because you've got 10,000 skeletons in your closet. So this is the fun part. I could talk for 2 or 3 hours on this. I won't put you through it, but tax structuring is, in my mind, the real tax planning. Everything that we've talked about so far, we're talking about savings in the hundreds or thousands. And when we get into tax structuring, this is where we have savings in the hundreds of thousands, if not millions of dollars of tax savings. So getting this done properly is critical for an eventual exit, for your income planning, and for retirement. So I believe that everyone is screwing up their tax planning without knowing it. This is by buying assets in the wrong place, investing in the wrong place, saving in the wrong place, buying insurance policies in the wrong place. You need to be really intentional about where you purchase those assets and where you spend your money, and make sure that it makes sense for your long-term goals. So you really need a roadmap. And that's what I'm going to hope to do here, or at least provide a baseline for it. So as a tax planning refresher, there are three big goals of corporate tax planning. You want to get inactive or bad assets out of the company, which is called purification. You want to get the right people owning the company, which is called restructuring. And you want to make money off of the government's money, which essentially is called deferring or deferral. So purification, we've got active assets and we've got bad assets or inactive assets. So the active assets are assets that are used in the business. So the ultrasound, computers, the practice building, in certain cases, the interest in an emergency clinic or shares in an emergency clinic. And bad assets would be assets that you don't need to run the business. So excess cash. Sometimes I see clients with $500,000 in their bank account. No practice needs $500,000 in their bank account. Permanent life insurance, which some of you may have, is not an asset that's required to run the practice. Market investments, things like shares in TD Bank, total market ETFs, other real estate. Maybe there's a duplex next door to your office, next door to your practice. That real estate is a bad asset for this test, and it's something that you shouldn't be in the corporation. And then there are personal assets. I have a shocking number of small animal vets that have horse trailers in their corporations. I don't know what the horse trailer is needed for in a companion animal practice, but there are personal assets. Sometimes we see boats, we see cars, things that don't necessarily are not necessarily needed to practice veterinary medicine. So purification is the process of identifying these bad assets and removing them. And then we've got deferral. So our corporate tax rates range from 9% to about 27% across the country, and personal tax rates exceed 50% at the top end in most provinces. So there's a deferral opportunity of 23% to 40%, depending on where you are. And the exact numbers are going to differ based on your practice and your province and your income, but at the bottom line, or the bottom line is, the longer you leave any cash or excess assets in a company, the bigger the benefit. So you want to be able to defer tax on that so that you're able to save as much money as possible. Because the longer you leave it in the company, if you've deferred 40% of your tax bill, that means you're investing that 40% of the government's money, and you're able to have that money grow between now and when you actually need to pay it to the government. So deferral is that, pushing that cash flow out into the future so that you can do something with the government's money before you have to pay those taxes. So if we talk about an org chart, so this is a lot of tax structuring is communicated in an organization chart. So individuals are words without any text. Companies are boxes with text inside them. Ownership is designated by a line. Investments are circles with words inside them, and investments could be portfolio investments, maybe it's a rental property, and then other assets could be the practice, insurance policy, but these are all things within a circle. And cash flow is designated with a line with an arrow on it. So some examples. This is some standard planning for a locum in Ontario. We would set up a veterinary medicine professional corporation that would operate the locum practice, and the veterinarian would own all of the shares of that professional corporation. So this is, easy basic planning. It makes sense if the veterinarian is making more money than they need to fund their lifestyle. If they're spending every dollar they make, maybe they're making 100,000 and they need 100,000 to fund their lifestyle. This structure doesn't really make sense. The corporation isn't worth having because all the money going into the corporation is flowing right out. The reason why you set up the corporation is so that you can enjoy some tax deferral. So maybe the locum practice is making $200,000 a year and the veterinarian only needs $50,000 to fund their lifestyle. By leaving that extra $150,000 in the professional corporation, they're able to enjoy a deferral by not paying any tax on that 150,000, or not paying the personal level of tax. So you're only paying the corporate level of tax on 150,000. And in some situations, that could be as significant as, $45,000 of tax deferral. So now you have $45,000 of the government's money that you can use to invest. So this is what bad locum planning looks like, because in this case, the locum is earning money with the practice. It sits in the professional corporation. The locum's taking the money out and then turning around and investing that money. So here we've got the investments outside of a corporate structure, which doesn't work because the locum's paying tax when they take the money out of the professional corporation. So they're paying an extra 40% tax. Say there's $100,000 left over. They pay 40% personal tax on that. So now they're left with $60,000 and they're only investing $60,000. Whereas if they invested within the corporation, now they can invest the full 100,000 because they haven't had to pay the personal level of tax. Just a couple quick questions that have come up. Um, we'll come back to the vehicle questions and mileage. We've got one question about, is it worth it to incorporate if locum income is less than 30,000? It really comes back to how much income you need to fund your lifestyle. So with $30,000 of locum income, if you have a salary that funds your lifestyle and gives you everything you need, you can pay your rent, your mortgage, credit card bills, pay for your vehicle, all of that. You've got a salary that covers that, and the locum income is secondary and only used for luxury items or investing, then it may make sense to incorporate. Other things you'd want to look at is whether there's RSP contribution room available. Because if you've got RSP contribution room available, you might be able to get the same benefit by maxing out your RSPs that you would with a corporation. So definitely something to talk about. People say, well, what's the number? Is it 120,000? Is it 200,000? Is it 50,000? Is it 30,000? Everyone's different because everyone's lifestyle is different, but it's a conversation to have with your accountant. So we talked about bad locum planning. This is the better structure. So where the locum is saving within the professional corporation. And because there's not a market for locum practices, because the value of the practice is really tied to the individual, there's no concern about having investments within the professional corporation. You're not worried about purification when you're a locum. So the bottom line is you want to defer taxes by saving corporately. So this is what bad startup planning looks like. You've got the veterinarian owns the professional corporation. Within that professional corporation, there's the practice, a building, and investments. So here you've got everything all in one bucket, and people think this is great. I'm saving on my financial statement and corporate tax planning. The problem is that when you go to sell this practice, you just want to sell that one asset, just the practice. Maybe you're selling to a corporate consolidator that doesn't buy buildings, and you've got your investments that you don't want to give to someone else. So now you're looking at selling the assets of the corporation rather than the corporation itself. So the reason why people want to sell corporations as opposed to assets is that when you sell a corporation, you're able to access the lifetime capital gains exemption, which is 1.25 million of tax-free proceeds for each shareholder. So if you've got a two-owner practice, $2.5 million tax-free. So this practice being stuck in the professional corporation along with the investments and the building is a problem because now you've just wasted $400,000 of taxes that you wouldn't have had to pay if you had a better structure with your professional corporation owning the practice and the building and investments being in a real estate company. So by moving the building to another company, you've got the ability to sell the practice within the corporation isolated. So you would sell the shares of the professional corporation, and then you would keep the real estate company. You'd collect rent to the real estate company. But most importantly for this example is you'd be able to access the lifetime capital gains exemption, again, with about a $400,000 tax savings. So you want to invest within a corporation. We've got a couple questions here. You do want to invest within a corporation, but you don't want the investment to be within the corporation that you intend to sell. You want to think about how long you're going to have those investments and whether you're going to sell them in the long term. So you want to move excess assets or excess cash out of the corporation to a holding company. And insurance is one that we see causing issues more frequently than not because insurance policies will be purchased within a professional corporation sometimes when really they should be purchased within a holding company. And you can run into issues with permanent insurance policies that I'll get into in a bit that make them very difficult to move. So you should invest within a corporation, but it should not be your professional corporation. If you're purchasing a practice, this is the way to not do it. This is the wrong way. This is what veterinarians had to do back in the 90s before veterinarians could incorporate. So the veterinarian would go to the bank, they'd borrow $1 million, they'd buy the shares of the practice for $1 million, and then they would pay personal tax on all of the funds that they needed to use to service that $1 million of debt. So that turns $1 million of debt into about $2 million of cash flow because you need to pay personal tax before you pay the bank. So you need to make $2 million. So you've got $1 million after tax to pay the bank. The version that I see screwed up now is the veterinarian will go to the bank, borrow $1 million, go buy the shares of a corporation that contain the practice, and then they need to take a dividend out. So let's say it's $1 million purchase price. They need to take $2 million of dividends out of the corporation to be able to pay off the bank. So the issue here is debt repayment is done personally after tax, and that's what causes a big issue. What you want to see here is the veterinarian will set up a holding company or an acquire company, and this can be a regular numbered company because it's not practicing veterinary medicine. At least those are the Ontario rules and most other provinces. So this can be a regular holding company. The holding company goes and borrows the money from the bank, and then the holding company purchases the share of the professional corporation. And then what we do next is the holding company would amalgamate with the professional corporation so that the cash flow from the professional corporation can be used to repay the debt. And the difference between a holding company and a professional corporation is the holding company is just here to hold the shares in the professional corporation. The professional corporation is the one that is actually public facing, where people see, people interact with it, get bills from it. The holding corporation, all it does is own the shares of the professional corporation. And in most cases, we would amalgamate the holding company and the professional corporation after closing. So when we talk about bonus points, on closing or shortly after closing, you would amalgamate those two companies to simplify your life, and then the debt for the practice is held within the same corporation. For most locums, hey Justine, there's no need to have a holding company for a locum because locums aren't going to sell their practice. So if we go back to this slide, this isn't necessary for a locum because the whole reason that we're moving the excess cash and assets out of the professional corporation is because we want to preserve the ability to sell the corporation. We want to preserve the ability to sell the corporation, and the only asset of the corporation at that time is the practice. So for a locum, because you're never going to sell your practice, or it's very, very unlikely that you would sell your locum practice, this isn't an issue. Having a bunch of assets within the same corporation that you're practicing from as a locum isn't a problem. If you're investing in GICs, that's the kind of thing that you want to move over to a holding company as well. So we're bouncing back to purchase planning. So this is our good purchase planning. We don't want to do this. So we don't want the building within the same corporation as the practice for the same reason that we didn't want it in previous structuring. But if you're buying someone else's mess, you want to separate the building. So you want the real estate company to own the building, and then you want a professional corporation to own the practice. And then you would amalgamate the holding company in with the professional corporation so that the debt that the holding company owed becomes debt of the professional corporation. So when two corporations amalgamate, the amalgamated company assumes the debt of all the predecessor corporations. So the debt of the two corporations becomes the debt of the successor corporation, the professional corporation. So this is the ideal structure that we work with when we work with clients who are purchasing a practice. We want the real estate in one building and we want the professional corporation in a different building. And this is where you want to end up, where you've got your professional corporation that owns your practice, your real estate company that owns your building. Professional corporation is going to pay rent to the real estate company. These two companies are going to pay off debt at a reasonable rate. And then as there's excess cash available, we'll set up an investment company that will own your portfolio investments. Ooh, 3 veterinarians. This is a good one. So Um, Sometimes we see, multi-veterinarian practices. If we had three vets coming in to buy a practice, this same structure would work. You would just have three owners, or sorry, this structure would work because you would have three owners of the holding company, and then the professional corporation would generate sufficient cash flow and pay off all the debt. This is the answer to Chris's question. If three veterinarians were purchasing a practice and each need to borrow one third of the cost to fund the practice, would you recommend a shared holding company or they each have their own holding company? One holding company is sufficient because all of the cash flow will be used to fund that debt, and then that holding company will ultimately get amalgamated with the professional corporation, like we've got in this stage here, and we would just have multiple DVM owners. And then we'll get into compensation for multi-partner structures, which gets a little bit messy. Okay. Um, Randy, it sounds like we missed you. I will reach out to you after this call. Um, and then, so this is where we want to end up. And I always advocate for owning your real estate because your rent will always go up. There's no question your rent will always go up. Your mortgage payment is going to stay fairly stable. You're going to have this uncomfortable part at the front end when your mortgage is higher than the rent you would be paying otherwise. If you can stomach this, you will be far better in the back end of your career. And then eventually your mortgage will be paid off. And then you have an asset that, you'll be able to sell your practice and then um, collect rent on that property and use it to fund your retirement. Um, a, a few years ago, I had two practices sell within the same month. One of them rented the real estate that the practice operated from, and one of them owned the practice building. And the guy that, they both sold for $1.5 million, let's say. The guy that owned the real estate also signed a $10,000 a month lease for 10 years. So you got another $1.2 million of cash flow out of this. And he has a building that's worth millions of dollars compared to the guy that just rented the building. So if you can figure out how to own your real estate, it's very, very, very lucrative in the long term. Just going back through questions here. Um, got some questions around whether dividends or salary is more appropriate, and it really comes down to um, your personal biases, what your personal situation is, and it's a conversation that we have with our clients to figure out what makes the most sense. And then another question as to whether accounting fees are reasonable. That one's a little bit loaded. So if anyone's looking for a quote or a conversation around how we would work together, that might be a good yardstick for whether you're getting good value for what you're paying. And then we'll get into partner compensation in a bit. And then another question around what kind of investments can you make inside a corporation. One of the reasons why I like investing within a corporation like this structure compared to RSPs is you can invest in literally anything. You can buy NFTs, you can buy Bitcoin, you can buy real estate, and none of those are eligible expenses for a RSP. So you've got much more flexibility and you've got much easier access to cash. All right. So when we talk about partner, a lot of vet clinics that I work with have multiple partners, which is fine when you have the same cost of living. If you're both living in the same house with the same spouse, or your spouses are earning the same income, maybe not the same spouse, but your spouses are earning the same income. You have the same number of children who have the same hobbies. Realistically, that never happens. One partner is going to have no kids, but a horse problem and have like 4 horses and a barn. And the other spouse, maybe married to someone who's financially successful and doesn't need as much income. So you don't want to tie yourself to your partner's income needs. So if you've got two partners, you've paid off the practice debt, and now there's just tens of thousands of dollars a month to split. Well, if DVMA has a horse problem and needs $15,000 a month for board, and DVMB doesn't have horses and maybe only needs 60,000 a year, you're going to want to keep salaries equal. So DVMB is going to end up paying more tax than they need to because they're contributing in the same way in the practice. It's not fair that DVMA gets $180,000 a year salary and DVMB takes a $60,000 a year salary. So those are, we want to look at how do we fix this? So this is the structure that we moved to with some of our clients when they've paid off their debt. Um, we've got two professional corporations. So each veterinarian or each owner would get a separate professional corporation. And this professional corporation will operate a lot like a locum corporation. So they will bill the central PC for a factor of their production. And then these funds can come over on a net neutral basis. So the central VMPC will save a little bit of tax, but the outside VPCs will pay that corresponding amount of tax. So on the whole, the group is neutral. And generally these outside PCs are paying tax at 12% compared to 50% or as high as 50% for the individuals. So we've got these outside PCs where they can accumulate cash. So let's say there's $600,000 a year of excess cash flow in the practice. The two veterinarians can take that as 300,000 each to their independent professional corporations, and then they can decide how much money they need personally. So DVMA can take out her 180,000 a year that she needs to be able to fund her lifestyle and her horses, and DVMB maybe she doesn't even take anything out. Maybe she leaves everything within the professional corporation and builds up this investment nest egg so that she's got, you know, significant corporate wealth when she retires. Um, so this, um, when we talk about sale planning, we need to isolate the practice. So this is a client situation that I worked with a couple of years ago. This guy was getting ready to sell his practice. So he had an offer on the practice, he had an offer on the management company, and they wanted to buy the building as well. So it wasn't a corporate buyer. And the proceeds were about $6 million. So the professional corporation was set up to employ all the DVMs and own the drugs. Steve, the veterinarian, owned the shares of the professional corporation and some of the shares of the management company. And then Steve had six non-veterinarian family members. And those six non-veterinarian family members each would get a lifetime capital gains exemption. And then they also own shares in the real estate. So the total purchase price, let's say it was $6 million. I'm fairly certain it was in that neighborhood, but you get the idea. So in an ideal world, you've got Steve plus six family members. That's six lifetime capital gains exemptions. It's more than enough to shelter the whole $6 million of proceeds from tax. Alternatively, you're looking at about $1.5 million of tax. So now there's a bit of a problem in Steve's structure here because his real estate company has an investment portfolio that's a bad asset for capital gains purposes. So this real estate company isn't eligible for the lifetime capital gains exemption because he's got a $1.25 million real estate portfolio or portfolio of investments within the real estate company. And then the other wrinkle is this insurance investment in the management company. That permanent insurance policy Steve took out in his 40s. Steve's now 60. He's had two heart attacks and is battling cancer. So insurance policies are movable, but it's a deemed disposition. And that life insurance policy is now like the value was in the tens of millions of dollars because Steve wouldn't be out. Steve is not insurable. If he went to get more insurance today, he would not be able to get a policy anywhere near as close to what that is. So there's no way that we would be able to move this insurance policy without paying a ton of tax, like like tens of million or millions of dollars of tax on that $10 million plus policy. So now the management company and the real estate company are both tainted from a lifetime capital gains exemption perspective. So these six lifetime capital gains exemptions are worthless. So the only person who can use their lifetime capital gains exemption is Steve on the shares of the professional corporation. And this professional corporation, so we're going to allocate 1.25 million of value. Steve's going to save 1.25 million in tax, but he's still going to pay tax on the balance of the transaction. So in this case, he's paying almost $1 million or over $1 million more tax than he should have. He has the right structure. And what I said at the beginning about everyone screwing up their tax planning without knowing it, it's things like this investment portfolio and this insurance policy. Those little decisions that you're making, you're like, oh, let's just stick this here. We've got the company set up. We've got the bank account. We need the money right away. Let's do this quickly. Those are the decisions that really screw up long-term tax planning. Because Steve has like the Cadillac structure here, the professional corporation, the management company, the real estate company. This was set up so that he could say he could shelter his entire sale from tax. But with the decisions that he's made since then, buying the investment portfolio and buying the insurance policy, he's really made a mess of his structure. So those two problems made it so that he's not able to get that lifetime capital gains exemption. So this is, the clean way to do it. You have the professional corporation and the management company. The professional corporation employs all the veterinarians. The management company employs all the support staff. There's a management fee that goes from the professional corporation to the management company. The professional corporation is the one that interacts with the public. This is the same structure that most corporate consolidators use. There'll be a management company in the back that's owned by the consolidator, and then a professional corporation that sits out front that interacts with the public. So this is a really good structure where you've got, the holding company, it's got leased equipment, leases, equipment, management fees, and then the drugs and the support staff and DVMs are in the professional corporation. Sometimes the support staff are in the holding company. It depends. This is an improvement on the structure that we had in the past. So we can have non-DVM owners of the management company own the shares through a trust. That's what this triangle is. So the family trust can allow you to multiply that lifetime capital gains exemption without giving your kids actual shares. So maybe your kids aren't old enough, maybe they're still minors. You can't own shares in a private corporation if you're under 18. So a family trust is a way to open the door to using their lifetime capital gains exemptions in the future. Maybe you want flexibility to allocate a gain to someone, but you're not sure what the relationship's going to look like in the future. Maybe your in-laws are included as beneficiaries of this trust. So it's a way that you can add flexibility without too much additional cost. So it's the same structure, but with a trust on top of it. This is another way that's good, or another good structure is we have the professional corporation and the holding company. The professional corporation owns the practice and the holding company owns the real estate and investments. Note that this only makes sense if you never plan on selling the real estate. If you plan on selling the real estate eventually, you would want a separate company for the real estate and the holding company. And then the last part I want to talk about briefly is just around retirement planning and death. So when you die, anything in your RSP is taxed at the top marginal rate, and anything in a holding company is taxed at a capital gains rate, which is generally half. So in Ontario, that's 53% for RSPs and 26.5% for holding companies. So if you're draining your holding company each year, because we've all been trained to never touch your RSPs, you've got $2 million of value in your holding company, $2 million of value in your RSPs, and you're taking $100,000 a year out of your holding company, you've got it backwards. What you really want to be doing is taking the money out of your RSPs first, because this is your highest taxed pool. And then your holding company, you want to save till the end. You want to die with your holding company, but $0 in your RSP. So as soon as you retire, you want to start taking money out of your RSPs. And then from an estate planning perspective, if you had an insurance policy within this holding company, you can melt the investment value and convert it over time to an insurance policy. And that insurance policy has no value on death, but allows for a tax-free pipeline from the holding company out to the veterinarian and the veterinarian's estate. This is where you want to end up with. You want to die with a life insurance policy that's fully paid up, a real estate portfolio, and then really no investments or RSPs. When I go, I hope my assets look like this. And thank you for your time, everyone. That's where we'll end off. Anyone looking for my email address, it's greg@vetcpa.ca, or you can find us on our website at vetcpa.ca. Um, I will just stop sharing my screen and we'll go through a few questions here with the time that we have left. Let's relocate the screen. There we go. Um, so Deanna, you asked about a contact email about Holdco, Investco, Realco. I'd be happy to talk to you. My email was on the last slide, or I'll drop it into the chat here. It's greg@vetcpa.ca. I'd be happy to talk to anyone that's interested in talking. The next question is on the lifetime capital gains exemption and around, so there's a 2-year rule for the lifetime capital gains exemption. Any assets that are going to be or any shares that are going to be accessing the lifetime capital gains exemption need to be pure for a period of 2 years. And what that means is you need to have the bulk of the assets within the corporation be active for the 2 years prior to a sale. So we need to, if you're thinking about selling, you want to start thinking 24 to 36 months ahead of actually selling. You want to start thinking about your tax planning. And that doesn't apply to a holding company because you won't be selling the holding company. We had a question around, would a family trust not be the answer for family members to get the lifetime capital gains exemption? That's exactly right, Chris. That is the structure that we'd ideally set up. Is the family trust owns the management company. In most provinces, you can't have a family trust own shares in a vet clinic, but they can own shares in the management company. And my email, okay, repeat email, super informative. Holding the real estate within a separate company within a holding company make things easier. So if you had the holding company and the subsidiary company held the real estate, so you've got holding company and then real estate company underneath, and then that real estate company would hold the real estate for the practice. That doesn't help things because you want direct ownership with the real estate companies so that if you are going to sell the real estate company, you can use the lifetime capital gains exemption. So Paula, you'd want the second company to be a sister company with the holding company, not, you don't want a parent-child relationship, you want a sister relationship. And then Vin, your question about whether a holding company is still recommended, even if you do not own the real estate. If you're starting to save corporately and starting to build up a significant investment portfolio, you do want to start doing that within a separate holding company, not within your practice. Um, and Deneen, your question about numbered company. So the question is, can a numbered company hold your real estate and accept management fees from the vet corp? It can. You just want to look at, is that the right structure long term, and is that something that you're going to be able to sell? So you want to look at, is that the right structure for you and how you plan on exiting your practice? I worked first as an estate accountant, so I did a lot of death taxes, and you can see that that's when the rubber hits the road. Is when you die. How do the chips land? And that's when you see all the mistakes that people have made. Um, there was a question around there being a little benefit in a holding company if there's unused RSP room. Given the tax rates on RSPs at death, it might still be better to build up investment assets in a holding company rather than RSP. Um, so one of my beliefs of tax planning is you want balance. So having all of your assets within a holding company isn't a perfect solution because the assets within that holding company are taxed in a way that the assets in an RSP are not. So you want some balance. You want to build up the money that you will conceivably use within your retirement, within your RSP, and then the money over and above that, generally you want to put that within a holding company. Okay. I think we're just about out of questions. Okay, one more. Um, is a locum practice that earns pretty much just as much to cover the expenses likely to be a red flag for the CRA? That's hard to say. So if you're making $10,000 a year of locum income and you've got $10,000 a year of locum expenses, is that a red flag? I've found that there are very few red flags for the CRA. It's just mostly white flags. So you got a lot of little white flags. And if that's the only irregularity in your tax return, it's probably not a huge issue. But if there are a number of irregularities or a number of those white flags, that's when it would become an issue, Chris. Okay. I'll stick around for the next 10 minutes or so if there are any questions, but if anyone wants to drop off, thanks for taking the time to join me today. We've got a question around locum meals while traveling. So any expenses that are required for you to be able to practice as a locum are locum expenses. So if we can make the argument that those meals were required for you to, uh, practice as a locum, then we can probably make that argument and we could claim those expenses. Okay. Uh, Timothy, yes, keeping track of several corporations and ownership and transactions, it is dizzying, and that's what we do. We focus on helping veterinarians as their life gets more complicated. So this is something that we definitely help with, and I'd love to chat with you if you're interested. Thanks, Jackie. Uh, if you've used part of your lifetime capital gains exemption, you can still use the remaining um, because it's indexed. So it used to be 500, then 750, then 800, then it scaled up to a million over time, and now it's 1.25. But if you've used part of your exemption on one transaction, you've still got the remainder left available to you. In terms of cloud-based bookkeeping software, I recommend Xero, Xero. I find it's the best structure and the best formatting of the reporting, easiest to use. We work with about 600 clients on Xero. All right. So we'll wrap it up there. Anyone that has any questions, I'm happy to take them by email and we can set up a conversation if it's merited. I'll put my email in the chat again, and feel free to shoot me an email and we can work through those questions then.
I'll jump in now. Just wanted to say thank you all for attending and a special thank you to our speaker, Greg Toner. So the recording of today's webinar will be available on CVMA YouTube channel within the next week or so and will be accessible for 30 days. Thank you. We can stay on and see if there's other questions,
Yep.
but
Yep.
all
That
right.
works.
Thank you.
If anyone has any questions and just wants to unmute and chat, we can do that too.
Hi, Greg. I think you might have missed my question. I was just asking
Oh,
about,
sorry.
I have just started a mobile rehabilitation practice and I locum.
Oh,
Um,
okay. Sorry. I see that now.
yeah,
Um, so are you incorporated or not?
no.
No. So I would set up two separate business accounts.
Okay.
So one for the locum practice and one for the rehab. Um, it's going to make it easier for you to track those expenses independently, and you'll be able to get an idea of which side of your business is actually making money. Because one thing that's hard when you lump everything into one bank account is figuring out, okay, which business is actually making money.
Yeah, that's what I have. I've been putting my local stuff through my personal account
Oh,
for
okay.
years. So that's why I was like, should I put it through the business?
No, I would set up a separate business account, but I would get it running through a business account as opposed to just your personal account.
Oh, okay. I just find the fees are way higher on the business account.
I know. And that's like the biggest complaint I get when people say, when I say, oh, you need a business account, they're like, but the fees are like $10 a month. I
Or
find the
more.
efficiency that you get, yeah, or more. The efficiency that you get in your bookkeeping and record keeping is like, I think outweighs that additional cost.
Okay. Even if you're not incorporated, because it's all one tax, like,
It's all one tax form, but being able to pull out the expenses and pull out the revenue, it's so much easier. And then when it comes time to paying your GST or HST, actually paying those expenses through your business bank account is far easier than trying to navigate the way to pay it through your personal account.
oh, that's fair. Okay. Yeah, I will do that. That's helpful. Thank you.
No problem.
And then I sent you an email. So I was like, I
Okay.
think we should probably chat.
Sweet. Looking forward to it.
Okay, thanks. Bye.
Bye. Alrighty. Randy, do you want to unmute and we can talk through your mileage and vehicle claim question? Just Randy, while you're doing that, Irene, you've got a question about a husband-wife team that's planning on locuming. Just one locum corporation would likely be sufficient.